Welcome to today's CPD update. So it's the payroll update, and we're joined by Pamela Coonan from BDO. Pamela is the Director of Outsourced Payroll Department with over 17 years experience. Pamela was previously with Ceridian as well, where she had from single payrolls right up to payrolls at over 3,000 members. With that, I'll hand over to Pamela.
Hello everybody, and thank you for joining me this evening. As Jennifer mentioned, my name is Pamela Coonan. I'm Outsourced Payroll Manager for BDO Limerick, and I'm just going to run through, I suppose, a few topical payroll, issues and updates that are coming ahead in the next year or so. So what I am planning on covering this evening is a brief overview of the budget. There wasn't too many payroll changes. CAR BIK, because we're going to see some big changes come January. Statutory Sick Pay, again, come January 1, we'll be seeing some big changes in that area. And then, of course, gender gap reporting, which is coming into play this year. So firstly, budget 2023. So I suppose some of the main changes that we're seeing coming through are in relation to tax credits. There's a €75 increase in your single person tax credit, which obviously leads to a €150 increase to the married and civil partnership tax credit, a €75 increase in the employee tax credit and the earned income tax credit. We're also seeing a €100 increase in the home carer tax credit. And from a salary cut-off point of view, the current band of 36,000 has been increased to 40,000, which is a fairly significant increase. The single, widowed and surviving civil partner standard cut-off point is increasing from 40,800 to 44,000. And the married couple or civil partnership one income standard cut-off point is increasing from 45,800 to 49,000. The married couple or civil partnership with two incomes is increasing from 45,800 with an increase of 27,800 for the lower income earner to 49,000 and a 31,000 increase for the lower band earner. And from a universal social charge point of view, again, not many changes. The second USC band is increasing by €1,625. That's really in line with the increase in the minimum wage, so that employees in that bracket are being caught in that band. And the reduced rate of USC for full medical card holders under 70, whose USCable income is 60,000 or less, is going to remain in place for 2023. And the emergency basis of USC will continue at 8%. I suppose some of the more interesting changes that we're seeing this year is the increase in the small benefit exemption. So previously you would have been able to give an employee a voucher to say to the value of €500. This has now been increased to €1,000. And another interesting change is previously you would be able to give that in one voucher. Now they've extended that up to 2 vouchers, and they've also made that effective for 2022. So for December and I suppose Christmas bonus payments or just vouchers as employers often give in December, I suppose you have the option now to give that additional voucher tax-free. Another interesting change is the rent tax credit. So although it doesn't, I suppose, really impact from an employer's point of view, employees who are in rented accommodation will now be eligible for a tax credit of €500 for a single person and €1,000 for a joint couple. So that's going to apply again from 2022. You'll be able to make that application early in 2023 and then from 22 to 25. So over the next few years. For those in receipt of state supports, they will not be eligible for this payment. And in relation to pension, I suppose there's been an interesting change there as well in regards to employers' contributions to PRSAs, whereas previously there was BIK implications there. They're making a change to pension, so it's more in line now with your normal occupational pension scheme, and no BIK charge will apply. I suppose you may have employees or clients even who have employees on some of these schemes. They have been extended. So you have your special assignee relief program. That's one we see quite a bit of. Basically, certain employees assigned to Ireland from abroad can apply for SARP. It's really more kind of key employees with earning levels over 75,000. So that is being extended till 2025, but they are changing some of the rules around it. For example, the threshold for new entrants will be 100,000. The foreign earnings deduction, so that's for individual residents in Ireland for tax purposes who spend qualifying time abroad. Again, that was due to end in December 2022, but has been extended out to 2025. Another program in place, the Key Employee Engagement Program, again, was due to end in December 2022, but that has been extended out to December 2025. So if you are currently availing of any of those schemes, or indeed any of your clients are, they are being extended for another 3-year period. From a social welfare and minimum wage point of view, the social welfare payments will increase by €12 effective Jan 1. So if you have employees, for example, on maternity leave, etc., you need to make sure that you are factoring those amounts into your calculations. Illness benefit will increase again by €12 from 208 to 220. All the general leaves, maternity, paternity, adoptive parents, they will all increase from 250 to 262. In case people aren't aware, from July this year, parents' leave increased to 7 weeks. As I mentioned when I was discussing the USC, the minimum wage has increased. It's increased from $10.50 to $11.30 effective Jan 1. So again, you need to ensure that if you have employees, or again, any of your clients have employees on the minimum wage, that they're aware of that change and they are making the increase in January. There is I suppose it's in the works. The minimum wage is going to be abolished over the next few years and really be replaced with a living wage, which would be about 60% of the median wage. So that they're hoping that that will come into place in 2026. Again, I suppose not really budget 2023, but very important, I suppose, closing off your 2022 tax year, and some things just to kind of watch out for. I suppose number one, you may have a situation where you have a week 53 or a period 14 for a 4-weekly payroll, or a fortnight 27 for a fortnightly payroll. So you just need to be really careful about that. They can happen, they can and do happen, you know, when you have your payday the first day of the year and the last day of the year. So where that situation occurs, you need to make sure that you're allocating an additional period's tax credits and cut-offs, and for both PAYE and USC. And I suppose a key thing to watch out for here is that you're taking into consideration your actual pay date. So if your pay date perhaps falls on a bank holiday and you have to pay a day before or a day after, you really need to be looking at the date that you would have paid. So if your normal payday falls on the 1st of January, and the employees can be paid the day before, which the last banking day before, which would technically fall in 2022, but you can run a 2023 payroll using that date. Very important that you only using the latest available bank date. So if you go a day before that, you're essentially changing that pay period to 2022, in which case you'd have to use your 22 details, and it wouldn't be a week 1 payroll. So it's just something to watch, particularly with the bank pay dates change around the Christmas period, just to make sure you're not that you are, again, whether you have a week 53 situation or not, that you're watching those pay dates and that you are taxing the wages in the correct tax year. LPT, another important thing to note is where you have a situation where, for whatever reason, perhaps because an employee was on leave and LPT hasn't been deducted in full, that you are notifying revenue that has happened. RPNs, we should have the 2023 RPNs available in early December. It's very important that no RPN details, and when I say RPN, I'm talking about tax credits, that no tax credit details from 2022 are carried over to 2023. So since the introduction of PMOD, you can't carry forward tax details. So if you don't get new 2023 tax details from an employee, you need to request them. And if you're still not getting anything down from revenue, that employee is essentially going to be on an emergency basis. It's something to watch out for. And I suppose it's always good to look at these things early in case you have a situation where an employee may need to contact revenue to get that fixed. Again, employee IDs should not be changed between tax years. I have heard of situations where that has happened and it's caused all kinds of problems. So just make sure that the employment ID that each employee has for that particular period of employment is carried through to the next tax year. So another thing that I suppose we have coming down the line, it's not going to be affected this year, but an interesting thing that was mentioned as part of the budget update is introduction of reporting of tax-free payments. So at the moment, most expenses are probably paid outside payroll with most organisations anyway, and even when they are paid through payroll, they're not reported to revenue in any way because it's just a net payment. So what revenue are proposing to do is to introduce real-time reporting of tax-free payments made by employers to employees. They suspect that this will happen in 2024. There's going to be a consultation process which will begin Q4 2022, and they are planning to introduce this change on a phased basis. Probably or most likely travel and subsistence, small benefits, including vouchers and tax-free employer contributions towards remote working are likely to be in phase 1. So at this point, we don't know really whether this will be reported through a payroll system or outside payroll. I suppose that will all become apparent after the consultation phase and probably towards Q3, Q4 2023. But it is an interesting one to watch, and there may be changes to people's current processes around that. So certainly it's something to bear in mind over the coming year. CAR BIK. As I mentioned, a lot of change is happening around CAR BIK in 2023. Firstly, electric cars. Previously, an electric car up to the value of 50,000 was exempt from CAR BIK. So this was obviously very popular option with both employees and employers because there was a major tax saving there. Only the excess of the 50,000 was used from an OMB point of view prior to 2023, but come Jan 1, this is going to change. So the exemption for cars under 50,000 is going to be phased out. In 2023, it's going to be reduced by 35,000, 2024 reduced by 20,000, and in 2025 reduced by 10,000. So just to give you an example of what that's going to look like, I have an example here of an electric car with an OMV of 60,000. So OMV is the open market value of the car. So for 2022, a car with a value of 60,000 would have had an exemption of 50,000. So the OMV for the purpose of calculating the tax liability or the value of the benefit in kind would have been 10,000. So how that would have looked would have been 10,000 by the rate of BIK of 30% would have had a cash equivalent of 3,000. So in 2023, that is going to look a bit different. The OMV of the car will have to be reduced by 35,000. So you will now be looking at an OMV of 25,000. So whereas the OMV was 10,000 in 2022, the very same vehicle will have an OMV of 25,000 in 2023. The rate of BIK on that would be 22.5%, which would have a cash equivalent or a taxable BIK of 5,625. So in 2024, the OMV will only be reduced by 20,000, meaning the OMV for the purposes of the BIK calculation will be 40,000. Again, the rate of BIK 22.5%, which will give you a cash equivalent to 9,000. Again, and then in 2025, that increase again. So you are looking at an increase from a cash equivalent of 3,000 in 2022 to 11,250 in 2025. So that is a significant change. And as I say, it's going to start from Jan 1, 2023. So now is the time to be communicating that really, I think, with employees and giving them an idea of, I suppose, the cost or the notional value of that going forward. Company cars in general are also going to change from 2023 onwards. So previously, the calculation was based on the open market value of the car and the annual business kilometres. So from January 2023, CO2 emissions are going to form part of the calculation. So we'll still be looking at the OMV of the car, but we'll now also be looking at the CO2 emissions and the business kilometres. So from a CO2 emission point of view, there's going to be 5 bands, band A to E. There's going to be within that then 4 BIK rates within each band, and the rates will range from 9% to 37.5%. So prior to 2023, the rates of BIK on a company car, or the rates of the rates would have fallen between 6% and 30%. So straight away there is an increase in the rates, regardless of the type of car. There is an increase in the percentage there. Again, vans will increase, currently 5%, and that is going to increase to 8% of the OMV. So just have some examples of exactly how that will look from a processing point of view. Well, firstly, we have the current rates of BIK. So you'll see there, anyone who is doing 24,000 kilometres and below are currently paying 30%, and that's business kilometres. They are currently paying a 30% percentage of their OMV, and right up there to your 48,000 kilometres and above, and they're paying 6%. So it's very different. That's going to look very different now. So you'll see here you have the 5 bands based on the CO2 emissions. So from 0 to 59 is band A, band B 59 to 99, until we get to band E, which is 180 plus. So then based on the category that the vehicle falls into, and the CO2 emissions of the car can actually be found on the logbook of the car. So I know that's something that the people really need to start looking at now, because you really need to see, as well as everything else, to see what the emissions of the car are. So within the different categories then, depending on the kilometres an employee is doing, so we're taking into example there band C, which is CO2 emissions of 100 to 139. If you have an employee doing say 40,000 kilometres, they would fall into the 18% bracket. So they've made it just a little bit more complicated. So I have a couple of examples on that. So firstly, we're looking at a vehicle with an OMV of 28,000. In this case, the employee has annual business kilometres of 34,000, and this particular vehicle has CO2 emissions of 120 grams, which gives you a vehicle category of C. So in 2022, the calculation on that would have been OMV of 28,000. The percentage BIK was 18%. That would have been based on the kilometres the employee was doing. And then the cash equivalent for this would have been 50,040. So in 2023, the OMV of the car stays the same. There's no change there. But because of the bracket, the CO2 emissions and the kilometres being completed, the employee now falls into the 24% bracket. So again, there's no change to the kilometres the employee is doing, but there is going to be a change in the cash equivalent of the BIK. So that's going to increase by 1,680. So again, not a massive increase, but again, it's something we need to make employees aware of, because there is going to be an additional cost to them. I have a second example there, and this is a car with an OMV of 55,000. So the annual business mileage in this case is quite low, so it's 10,000, and the CO2 emissions are 142, which falls into category D. So this employee, obviously only completing 10,000 kilometres a year, was in the highest rate of BIK anyway. So there in 2022, that looked like 55,000 by 30%, which was 16,500, which is a significant BIK. But you'll see there from the calculation for 2023, that's now gone from 30% up to 33.75%. So an increase of €2,062.50 over the year. So a lot's going to depend on the class that the the employee's car falls into. And again, now is the time to be looking at those logbooks, confirming the amount, and I suppose communicating the changes to the employees, because regardless of, I suppose, even the vehicle they drive, there's definitely more of an upward lift in it than a downward one. So example 3 then is a van, much more simplistic calculation, but again, an increase. So in 2022, OMP is 42,000, the BIK is 5%, which is cash equivalent of 2,100. So 2023, again, the OMP remains at 42,000, but you have that increase of 3% to 8%. So overall, there's an increase of 1,260. And again, as well as the increase to the taxes due from the employee, there is the employer PRSI element there. So what I would say to any client or any employer looking at their fleet, now may be the time to start looking at electric cars or looking at cars in the lower CO2 bracket, because there's obviously a saving or a possible saving on employer PRSI to be made in that area. Statutory sick pay, so that's another big one for people to watch out for come January, and it's one where we haven't even received full clarification on some of the pieces of it. So it's due to commence 1 January 2023. So what this entails basically is paid sick leave for up to 3 sick days per year for 2023. It'll increase to 5 days in 2024, 7 days in 2025, and 10 days in 2026. The rate of pay for this is going to be 70% of normal wages, so an employee's normal daily rate, up to a maximum value of 110 per day. So employees with more than 13 weeks or more service will be entitled to this, and it's continuous service, so it's unless you've been dismissed or taken voluntary leave. One to watch out for is if you have an employee who leaves and comes back again within 26 weeks, it's going to be the aggregate of both periods of employment that will make them eligible. This paid leave will need to be certified by a doctor, so the employees will need to be certified as sick, and it can be taken in 3 consecutive days or non-consecutive days. So for calculating periods of continuous employment, what do we include and exclude? So the first 26 weeks of illness, layoff or leave agreed by an employer are included, as is any protective leave, such as your maternity leave, your adopted leave, your paternity leave, all those type of leaves. Strike or lockout of another business is also included, as is time in the reserve defence forces. So what is excluded then is any week where employee is not normally expected to work 18 hours or more. So that's for full-time employees. Part-time employees would be outside that, because that might be their normal week. It also excludes any time in excess of 26 weeks due to layoff, sickness or injury, or leave agreed by employer, and any strike relating to your own employer's business would be excluded from continuous service. So statutory sick pay is calculated at 70% of an employee's daily rate, as I mentioned, and this is capped at €110. So this is very straightforward for people who have the same daily rate of pay, but obviously not everybody is paid the same rate of pay for a day's work. You could have people being paid for piece work or things like that, and there is still a question with the department about exactly how employees with variable pay are to be calculated. So I know from speaking to my own software provider, the Software Providers Association of Ireland have actually put a letter to the department stating that the software is not going to be ready unless they get clarification on a number of points. So we're still waiting to hear back on that. But as it stands, there still is some question marks around it. But what we do know is from a daily pay point of view, basic pay is included, premiums including shift pay are included, piece and incentive rates are included, allowances are included, and things like monetary value of board and lodgings are included. So really, I suppose, for more clarification on that, where it's standard and people are on shift and they receive the same allowances and they receive the same payments, the same shifts, and everything is very consistent, that's kind of easy. I think it's more where people aren't that straightforward and work various different shifts and hours maybe and things like that, and still needs a little bit more clarification. So really, I suppose this mostly impacts employees or employers who do not have an existing sick leave policy. So if you have an existing policy and it is more favourable than the 3 days, say for 2023, then you can use your own policy rather than this. So it's a replacement really for, so it's not an addition to any existing policy you might have. This really is for employers who don't have a sick scheme in place, or, you know, where a scheme is in place and it's less favourable than this, then this, you know, you really need to follow the rules around this. It's your minimum entitlement. So I suppose, as I say there, the Act does not apply to any employers who already have a more favourable sick scheme in place. From a payroll processing point of view, it's going to be treated through payroll as gross pay. It's going to be liable to all the normal taxes. So PAYE, employee and employer PRSI and USC, and it will be included as reckonable pay for insured weeks purposes. So if an employee is receiving this sick pay, they are entitled to an insured week for that, and it should be applied. It cannot be treated as part of any other type of leave, so it's its own separate leave type, and you may accrue annual leave and public holiday entitlement while you're on this leave. It is also reckonable for redundancy purposes, and time spent on probation, training or apprenticeship may be extended on return to work. So there's a lot of points in there, but I suppose the most important thing is, if you don't have a sick policy in place, this is something you are going to have to introduce, or indeed, if you have a sick policy in place, you need to look and compare and make sure that if you're going to keep the policy you already have, that it is more favourable. And that when you're processing this through payroll, you are processing it through and applying all the relevant taxes to it. So there are situations where an employer may apply to be exempt from the statutory sick pay scheme. They will have to apply to the Labour Court for a temporary exemption from it. They must have the agreement of the majority of employees, and they cannot apply for it for less than 3 months or exceed a year. They may be granted one temporary exemption, and the Labour Court's decision can only be appealed to High Court on a point of law. So it's highly unlikely, I would imagine, that an employer would follow this route. It's likely if an employer is in trouble, and from what I understand, there has not yet been any applications for exemption from the scheme, but we may see that over the coming year. So penalisation records and redress. So this is the important piece if you don't follow the legislation. So the Act prohibits employers from penalising or threatening to penalise employees for exercising their entitlement to statutory sick leave. Records must be retained for 4 years. There's a fine of up to €2,500 for not applying the scheme, and redress can be applied up to 4 weeks' pay for employees. So gender gap reporting. Again, gender gap reporting is coming into place this year. So from June was the month this was to be applied, and the reports will have to be available in December. So there's a lot of talk about this at the moment, I know, in my office. So the Gender Gap Pay Information Act 2021 came into effect on the 31st of May 2022. So under the Act, employers are required to report and publish information relating to the pay of their employees by reference to gender to determine if any pay difference exists. So it's very important not to confuse this with equal pay. So it's not about equal pay for equal work here. Really what the government are trying to identify is the different levels within an organisation males and females are at, and where the gap maybe there exists. So again, it's not about equal pay for equal work. That's been dealt with under separate acts. It's really more about the level people are at within the organisation, what they're getting paid at that level, and I suppose how they bridge the gap going forward there. So the gender gap or pay gap refers to the difference between the average hourly rate of pay between men and women across a workforce. So that's every level from the very bottom to the very top across the workforce. Employers will have to identify all applicable payments made to an employee during the reporting period and divide by the number of working hours in the reporting period. So I suppose there's a piece of work really to be done there to look at the payroll, look at all the different payments that you're making to employees, the different benefit kinds, different bonuses, how they fit into this, and then look at the hours the employee works, and I suppose to identify the hourly rate for each employee. The gender pay gap is calculated by taking the average hourly rate of a female employee as a percentage of the average hourly rate of a male employee. So I have an example further along on exactly how that is calculated. And then if a pay gap exists, the employer must identify the size, the reason, and the action to be taken to eliminate or reduce it. So there's definitely a piece of work for employers, on that. So for 2022, what organisations are obliged to report? It's those with employees of 250 or more. And that will then be extended come 2024 to employers with 150 or more, and then in 2025 to 50 or more. And from what I've read on it, I don't believe they will drop that below 50. So it's likely from 2025 onwards, it'll be 50 or more. So it's going to be organisations both in the public and private sector. And when we talk about 250 employees, it's going to be 250 employees. So it's going to be any organisation with 250 employees on the snapshot date. So the snapshot date we'll cover again as we go on, but it's a date in June 2022. So the headcount will include all employees and apprentices, part-time and temporary employees, any agency workers, public office holders. So if you have directors, they'll be included. Those engaged personally to carry out work or service. It does not include partners within a partnership, but they can opt to include them if they so like. So there's a lot on this slide, but I suppose this explains exactly what they're looking to be reported. So first, it's the mean hourly pay between men and women. And again, I have an example of that up ahead. Then it is the median hourly pay between men and women. And that is going to be captured firstly for full-time employees, then for part-time employees, and then for temporary employees. So you're essentially going to be doing 6 calculations there really. You're going to do your mean and median for full-time, mean and median for part-time, and mean and median for temporary. You'll then be looking at the difference in the mean bonus pay between men and women and the difference in the median bonus pay between men and women. And again, you're going to be looking at that for your full-time employees, then your part-time employees, and then your temporary employees. So you're also going to be looking at the percentage of men who receive a bonus or BIK and the percentage of women who receive a bonus or BIK. And as I mentioned, part-time and temporary employees are going to be reported separately. So for each of those headings, you're going to have to do it for 3 cohorts really of employees. Those employees then will be divided into 4 separate bands: the lower middle, the upper middle, and the upper quartile. And you have 6 months after the snapshot date to report and publish your findings. The employer, you must report those findings either in the company website or someplace which is accessible to all the employees and also the general public. You also have to explain the reason from your point of view for the differences and any measurements you may be, or any measures you may be taken to address those differences. So what employees should be included? And I have been receiving quite a few questions around this from some of our clients. So it's any employee who's employed on the snapshot date. So you need to carry out a head count of all employees on that date. So for example, if you have an employee who is employed on that date, but you haven't yet paid them. So for example, you choose a snapshot date of the 30th of June. You may have employees who started on the 25th of June, but haven't yet been paid. They'd be captured in July payroll. So for the purposes of the head count, you include them, but they would not be included in your calculations because they haven't yet been paid. Similarly, with employees who've left, they are not included in the headcount because they're no longer an employee, but however, they may be included in the calculations because they were paid during that time period. So any employee on leave, such as annual leave or maternity leave or sick leave, they're all included. As I said, ceased employees are not included. As I mentioned, new employees are included. And I suppose very importantly, if you have employees who do not self-identify as either male or female, they are completely omitted from the calculations entirely. So as I mentioned, the snapshot date is the period up to the date you choose in June 2022. So you can choose any date in June, and then you're working back 12 months from that. So from an employer point of view, you will be required to calculate the total number of hours worked by the employees during that period, the total ordinary pay they received, the total bonus pay they received, and the total benefit in kind they've received. And as an employer, you will need to categorise part-time and temporary employees. So calculating the total numbers of working hours. So that's going to be simple for some employees, but again, not everybody. So it's really the hours the employee is available or required to be available at or near the place of employment for the purpose of work. And you only need to include hours where the employee is awake. So where you would have situations maybe where employees, you would probably have where employees are overnight, maybe social care workers in a house who sleep over, or nurses maybe, that kind of thing. Now, how you'd identify the hours when they're awake and they're asleep, I'm not exactly sure, because I'm not sure people would be logging that. But the idea is it's only hours where the employee is awake. You would include overtime, annual leave, public holidays, and maternity leave within that. And you wouldn't include things like unpaid leave, such as a career break or additional unpaid maternity and things like that. So there's a number of methods for calculating total working hours. So the exact hours worked, so where you have a situation where you have a T&A system, probably larger organizations, maybe manufacturing particularly, or retail, where employees are clocking in and out, you would have the information available to be able to use the exact hours employees worked. Method 2 then would be normal set hours. So where you have employees who are contracted, probably your average salary paid employee who has contracted maybe to 39-hour a week, you would be looking at their contracted hours. Where you have a situation then where employee has no normal working hours, what the legislation is saying is that where they've worked at least 12 hours during the reporting period, you're to take the total number of hours worked during the 12-week period ending on the reporting date, divided by 12 and multiplied by 52.14 to get the equivalent working hours. Where you have employees who are completing piecework, and you can calculate the number of hours worked by the employee on piecework during the reporting period. So again, pretty straightforward where you have a T&A system or where you have employees who are being paid salary and are on contracted hours. Not so straightforward, perhaps, where you have employees working, very variable shift patterns or completing piecework. So pay types, again, this is a very important piece, and I know I personally have been receiving a lot of questions on it about how to identify which pay types to use or not use under certain headings. And again, I think there's been a lot of back and forth looking for clarification on some of the pieces here. So, from what I've read and what I'm seeing, when we are talking about ordinary pay, we are looking at things like basic pay, overtime allowances, holiday pay, shift premiums, pay for piecework, and sick pay. So all your basic ordinary, payments that employees would receive on a regular basis. What would be excluded from that would be redundancy payments, benefit in kind, any vouchers, bonuses, or expenses. From a bonus pay point of view, you're talking about bonuses, commissions, shares, profit shares, productivity pay, and vouchers. So, and that would exclude anything like ordinary pay, redundancy, and benefit in kind. And then from a benefit in kind point of view, you're looking at anything that's notional pay or remuneration other than money. So from a benefit in kind point of view, they're only looking to see the percentage of males and percentage of females who receive BIK during the report period. So they're not looking for the amounts of the benefit in kind. They're just looking really to see, okay, so how many males are receiving these benefits, how many versus how many females are receiving them. I know there's a question mark from an IPAS session that I was on about where shares are a BIK. So where they're BIK, they're processed as a BIK, but should they be captured as the bonus pay or should they be captured as a benefit in kind? And to be honest, the two guys on the presentation from IPAS couldn't agree between themselves. So that may be one, if you have a question about it, to put, there is an email that you can email with any queries you have on it. But as they said on the webinar I was on, really the important thing here is that you're consistent, and what you're doing for all the females, you're doing the same for the males, so that when you're calculating this and looking at calculations and how you treat the various components of pay, that as long as you're doing the same thing for everyone, you know, you're being consistent, and that's the important piece. So again, calculating hourly rate of pay. So you're going to need to identify, as I said, the ordinary pay and bonuses paid to employees during the period. You're going to need to exclude any amounts which relate to work done outside the reporting period. So you're going to see that particularly with things like overtime that's paid in arrears. So you will need to exclude anything that's paid. So for example, and it's quite likely in June, if you have employees who work overtime or for various different reasons, it might be a back pay that was due to them that's processed through the payroll in June, but actually relates to May or some prior period other than that, or, you know, that should be excluded. Also, it's important that you adjust any bonus pay to match the reporting period. So an example I've seen on that in some of the regulations was, if an employee receives a bonus and it covers an 18-month period, you need to ensure, you know, that only 12 months worth of that bonus is being included in your calculation. So what you then do is calculate the total ordinary pay and bonus pay and divide this amount by the number of working hours worked during the accounting period. So as I mentioned, it's not really as simple as that. There's a little bit of work in getting it set up. I suppose understanding what's included under the various headings, deciding how you're going to calculate out the hours for the employees, and then to get to that average working hour. So here's a very simple example of how the mean and median then are arrived at. So in this example here, we have 3 males. The first one is being paid 15 euros an hour, the second 25 euros an hour, and the third 20 euros an hour. So a total of 60 euros. The females then we have number 1 is being paid 11 euros, number 2 is being paid 15 euros, and number 3 is being paid 17 euros. So the total pay there is 43. So in order to arrive at the mean for the male is the 60 euros divided by 3, which is 20 euros. For the female, it's 43 euros divided by 3, gives you 1433. So when reporting this, and again, it's very simplistic, when reporting this to revenue, you will be looking, or not to revenue, when reporting this on your website, you will be looking at the difference between the two. So 20 minus 1433 divided by 20, which gives you a percentage of 28.35. So again, very simplistic, but really what you're doing is you're dividing up the pay of all the employees, of all the male employees, to get your average there. The same with the female, and taking one from the other and dividing that by the average of the male. The median then, which is basically the middle pay. So for the example here, that for the male, again, very simple, it's 20 euros. For the female, it's 15 euros. So again, you're taking the male, which is 20 euros, less 15 euros, and dividing that by the male, which is 20 euros, to give you 25%. So again, very simplistic, but that's basically what the figures you're trying to arrive at. And you would then be doing that for your full-time employees, your part-time employees, and any temporary, any temporary employees you have. So when you then need to report that into 4 different sections. So you have your lower remuneration quarter band, your lower middle remuneration quarter band, your upper middle remuneration quarter band, and your upper middle, should I say, remuneration quarter band, and upper remuneration quarter pay band. So essentially what they're looking to do is they're looking to see the divide within 4 different bands. So really, so they can get a full view across the whole organisation, from the top earners to the bottom, to see where the biggest gaps are. And I suppose this is only part of it then, is to get the information, find out where the differences are across the different sections, and then report that to revenue along with the reasons. Now, it could be something as simple as the industry you're in. It's just an industry where male people, for whatever reason, tend to be at the higher the higher areas, and and I suppose it's really looking at kind of I suppose looking at part-time, looking at temporary workers. They're really trying to see, is it because I suppose sometimes with women, they're out of the workforce for a period of time, or maybe they've chosen to go part-time because they may be doing more of a care role in the home, and they're really trying to see across these different areas, across these different bands, and across full-time, part-time and temporary, exactly where we're seeing this gap in pay, and again what organizations plan to do to reduce that gap, or maybe in some cases the gap is there for a very good reason, and they're really looking for, I suppose, organizations to tell you the reason for that. And also to see, I suppose, if organizations are going to look at their current policies for hiring, for recruiting, and career progression and things like that, to try and kind of reduce that band. A lot of clients now that I have spoken, or people in general, I suppose, are a little bit worried about what the statistics around this are kind of going to look like, and I suppose the fact that they have to be published on the company website or somewhere where they're available, to be viewed, and maybe has people a little nervous. But I suppose really it's to identify at this point, kind of where the gaps are, and then maybe as an organization look to see, where can we reduce these gaps, and is there a reason that we need to reduce them? I think some organizations that I suppose been talking to around it have kind of been worried about it. But as I say, until we have the information, we're not really going to know what this is going to look like. I think it's going to be very interesting. And again, back to reiterate, this really isn't about equal work for equal pay for equal work. It's more about looking about kind of what level men and women are at across an organization, which is, I suppose, the reason for these 4 bands, so they can see where the differences are, and where, I suppose, what level in the organization. I've added, and I'm going to share the slides afterwards and they can be circulated, but I've added some links here to some of the regulations and the FAQs particularly, because there's already been quite a few questions back on this. So I would suggest for anyone who does have to report on this year, have a good read on that. We're already in November. In 2 weeks' time, anyone, I suppose, who's picked a snapshot date of the 1st of June will be reporting in as soon as 2 weeks' time. So really, if there's a piece of work to be done on this, and there's some really good guidance in there. And if you haven't started working on it, I suppose really you need to kind of push on with it. I know a lot of the payroll software will be assisting with this, and we have received updates and whatnot. Kind of behind time on it because there was a lot of queries and back and forth with the software on it. So and I suppose the software is only as good as the information we put into it. So it's important to go through the pay codes that you're using, apply them correctly and work on the calculations from there. So that is really all from me on it. I imagine people may have questions.
That was great. Thanks, Pamela. So there's just one question in so far, and if anyone else does have questions, do feel free to drop them into the chat or Q&A. So the question is, for the increased value on the small benefits, is that just for this year, or is that the value going forward?
That's the value going forward.
Perfect. And
so I think it's a great opportunity there for employers, really, especially employers who like to give a payment in December, particularly when it's been applied to 2022. It's a really good opportunity for people to use that.
Definitely, and hopefully employers actually make use of it as well.
Yeah, absolutely.
Doesn't look like there's any more questions, so we can leave it there. Thanks a million for doing this for us today. Hope everybody enjoyed it, and we'll make the slides and the recording available as well afterwards.
Okay, that's great. Thank you.
Thanks, everybody.